Tyler Laundon. I'm the Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities here with your Cabot Weekly Review. It is Friday, September 20th, and just after the market has opened. It's not showing up here on this chart of the S&P 500, but the broad market is flat to slightly down here at about 9:40 a.m. Now, of course, market was up nicely. As you can see here, the S&P 500 broke out to another new high. Of course, the tailwind for that was that on Wednesday, the Federal Reserve lowered the federal funds rate by 50 basis points. Also yesterday, Thursday, we received good economic data. Jobless claims fell. 2 regional business surveys showed strengthening in September, and the August reading of the Coincident Economic Index rose to a new record high. So take that all and you're like, well, maybe the Fed didn't need such a dramatic cut. But on the other hand, the pressure now is off for a little bit. There had been talk about how the Fed was maybe behind the curve by not cutting in July. Of course, because there was no meeting in August, there was no change to policy in August. So perhaps this 50 basis point cut this past week was a recalibration. Those were Powell's terms. Some think that is another word for a makeup cut, which is probably pretty accurate. But now there's no meeting in October. So the Fed is going to deal its next hand on November 8th. That is just 2 days after the U.S. presidential election. This 50 basis point cut probably gives the FOMC a little bit of wiggle room at that meeting. Now, let's step back and think about the market here, okay? There is some data showing that rate cutting periods have some volatility, but realistically, when is there not volatility these days in the market? Bigger picture, when there is no recession, stocks tend to do well from the start of a rate cut cycle. That recession, caveat obviously is a big one, but at the moment, things look pretty good in the economy. I looked at some data from JP Morgan this morning. They noted that in each of the last 5 easing cycles, the S&P 500 had been higher on a 1-month, 3-month, 6-month, and 12-month trailing basis. So pretty bullish there. You can see this chart just started ticking here with the S&P 500 now showing down 0.15%. And again, it's about 9:40 a.m. Eastern time, so the market just opened. Now, again, headlines, small caps are back in the headlines. The reason is that lower rates are very good for the S&P 600 small cap index and the Russell 2000. Both have a much higher allocation of companies with floating rate debt, variable rate debt, than are in the S&P 500 large cap index. So as interest rates come down, financing costs for those companies come down, and again, disproportionately benefits smaller companies. The Russell 2000 has been up for 7 straight sessions. Let's go to a small cap chart here after the NASDAQ. As you can see, NASDAQ about flat on the day, pushing up against resistance here right around that 18,000 mark. Not quite to an all-time high, but certainly looking pretty good. Here is the S&P 600 small cap index, down marginally today, but again, pretty nice stretch here going into the FOMC meeting, and definitely small caps looking to push through this resistance in the 1435 to 1465 range, which would mark a new high for the year, of course. Now, one of the reasons, again, for small cap strength is the high allocation in the indexes to companies with variable rate debt. Another area, because, for me, small cap growth investor primarily, not getting into utilities that heavily or industrials and that, although we do have some of that exposure. We really are focused more on growth names. And small cap software and mid cap software are an area of interest right now. Those companies tend to do well when interest rates fall because it helps valuations. Now, we look at software stocks. They really got beat up when the Federal Reserve started raising interest rates. They traded at high valuations. There was a lot of excitement during the pandemic about cloud software and software in general. When the AI hype train began, it was largely focused on hardware, semiconductor, and infrastructure tech stock names. So a lot of the pure play software names, especially in the small and mid cap area, they continued to suffer. It didn't really help that small and mid-sized businesses weren't doing that well. Those areas of small cap software called SMB area of software, that customer base was struggling. That led to numerous downgrades over the quarters, and that even extended into the first quarter of 2024. Now, Of course, we just got through the second quarter earnings season a couple of weeks ago. Software stocks have been holding up much better. The economy seems to be doing okay. Interest rates, as we just discussed, are falling. That's a tailwind for valuation. And we now have a little bit more clarity on how a lot of these software businesses are evolving and how AI fits into the mix. Also, as we look back at the second quarter earnings season, there were more upward revisions than guidance cuts. That marked a change in that pattern, partly because of how management teams lowered expectations in the first quarter, but still, more upgrades than cuts is a benefit. It's a positive. And now sentiment towards software stocks is definitely improving. If we look at a chart of one of the broad-based ETFs, this is the Cloud Computing ETF, CLOU. As you can see, it's not like a runaway train or anything, but up against resistance here, overhead resistance at about 20.5, which is where this ETF got to in July and then again in August. And again, I'm not saying that this is a bullish chart, but it's certainly positive. And with this tailwind of rates falling, I do think there's a pretty good probability of this ETF and other cloud software ETFs bursting out to the upside. And of course, what we want to do is look at some of the more attractive names in those ETFs to play that trend. So we're going to get into 3 small and mid-cap software stocks now. Again, these are not official recommendations, but they are stocks that I think are interesting, and they're certainly on my radar and I think should be on yours. So let's move on to the first one. This is Docebo. I don't know anybody that knows this company's name, but it is a small cap Canadian software company. Ticker symbol is DCBO. Market cap here is, as you can see, 1.4 billion. It's right up in this area. Like I said, small Canadian company. They have a learning management software platform that is disrupting that market. Pretty easy to use learning platform. Their solutions have artificial intelligence baked in, and they're used by learning admin teams to centralize learning materials that are used by both internal employees as well as external partners and customers. Now, that is a trickier use case for a lot of these types of products, but Docebo has done a pretty good job and is excelling in that area of the market. And there are a lot of use cases there, so that's good for that area of the market. Again, big picture, it's a play on the trend to make employees and partners more productive, better equipped to do their jobs and move their organizations forward. Pretty easy to wrap your mind around that. It's also a high quality company, generates positive growth, profitable growth. Revenue should be up around 19% this year, and EPS should be up by about 50% to 95 cents a share. Docebo may be eyeing acquisitions. It has good cash flow. It has 82 million in cash in the bank, and it seems like momentum is building. As you can see on the chart, it's been going north for the last couple of weeks and looks like it's trying to move up through this 45, 46 area. All right, next up is CLOU. Bit of a high flyer here. Market cap of 4.5 billion. Ticker symbol YOU. I said the company's name was CLOU. It's Clear Secure. Ticker symbol is U. What do they do? So they have a security identity platform. Most people are going to recognize this when they're traveling. It's Clear Plus subscription product. You see it all over airports. It has biometrics that help speed things up when people are going through airport security. But Clear is also expanding beyond travel. The big takeaways from the second quarter earnings report are that even though there is some softness in the domestic travel market, Clear's bookings were better than expected. They're also scaling up their TSA PreCheck and verified product. That's surprising to the upside. There's momentum around improving the member experience with things like a perks program, and new technologies like Face First are finding their way into solutions. It looks like the company should have a pretty good second half of 2024. I think that's why the stock has been doing so well lately. As you can see coming out of this earnings report in early August, big breakout there and then a significant upside move. So a lot of people understandably a little bit hesitant to buy a stock that has a chart like this. Again, we're not getting into official buy recommendations and all of that, but I think it's a compelling company and it's worth doing a little bit more research on it. When we look at what analysts expect for the year, they see revenue growing by about 24%, earnings growing by about 120%, so big upside there. EPS of about $1.27 this year. I mean, that's obviously impressive growth and profit for a company with a market cap of about $4.6 billion. All right, last but not least is KVYO. Ticker symbol here is KVYO, and a little bit of a bigger company. Market cap is almost $9 billion. KVYO has a marketing automation platform that helps customers generate returns from their marketing investments. The company also is a data specialist. This feeds into its AI strategy. Of course, a lot of AI relies on data to do what it does. The AI product development roadmap is focused on productivity tools that are baked into solutions to help optimize marketing campaigns. A lot of this is done through emails and text messages, and there are more strategies that are being developed that leverage both of those modes of communication together. There is not a specific AI product that KVYO is monetizing at this point. Again, it's more like the technology is baked into all of its solutions. Its products are geared toward the retail and e-commerce areas of the market. That's where about 95% of revenue comes from. So absolutely, if you're interested in KVYO, be thinking, retail, e-commerce. Those are the markets where it plays. Its products were designed for online stores on Shopify, BigCommerce, and Magento, but Shopify is where most of the action is these days. The company put up a pretty impressive second quarter beat, reported on August 7th, which drove this big upside rally. The stock was up almost 33.5% that day. Again, August 8th was the day after it reported on August 7th. Management reported revenue growth of 35% to $222 million and earnings growth of 67% to 15 cents a share. That puts the company on track to grow both the top and bottom lines this year in the 30 to 35% range with some upside potential. So clearly another pretty attractive profile for that software stock. All right, guys, that's 3 software stocks. That's it for me. Hope you have a nice weekend, and we will talk to you next week. Take care.